This special podcast is brought to you by Futuregrowth, whose Chief Investment Officer, Andrew Cantor, joins us now. Andrew, interesting discussion that's going on at the moment about the potential downgrade of South Africa's sovereign status. We've had updates in that regard, but I'd love to start off with this Eurobond that South Africa has just placed in the global markets. And if you could just maybe unpack it for us. On the level of the rating, it does appear that we've paid up a bit more than in the past.
Right. So broadly speaking, the whole talk of the market, the world around South Africa has been downgrade. And I think by and large that has been in our sovereign spreads for the last couple of months anyway, certainly since Ninigate in December. So South Africa is already priced like a double B credit, while we are technically still a triple B issuer in the world.
Mm-hmm. Just explain the difference between the two, triple B and double B.
Okay, so when we talk about credit ratings, as you know, they go from a scale from AAA, which is basically very low risk, very high quality, all the way down to through AA, single A, triple B, double B, and so on down to D for default. Once you're below what's called triple B, you are called sub-investment grade or junk debt. South Africa is flirting with that now. We are in the triple B space by all three major global ratings agencies, but the outlooks are negative, and because of the degrading fiscal situation in South Africa and the low growth outlook and policy uncertainty, the expectation is that the Standard & Poor's and the Fitch and the Moody's of the world are looking to downgrade South Africa possibly below the triple B level into the junk debt territory.
As an indication, though, the Eurobond that was now placed, would that have put us in the triple B, in other words, the investment grade rating, which we officially hold at the moment, or is it in line with what a double B would expect?
Right. So as I said, we have been for the last couple of months, and on this bond as well, been pricing as if we were a double B asset. Or put differently, the spread on our international bonds is the same as other countries that are already rated double B. So in that regard, we talk about a downgrade, and people say, well, what does it mean? And the answer is it's already in the price. The answer is from an international pricing of our cost of capital as a country, the country is already being priced and paying up as if we're a double B rated entity.
What is the difference, particularly because it's a good example now to use this $1.25 billion Eurobond? What would South Africa have paid if it were rated as a triple B rather than the actual price that was paid?
Okay, well that's sort of a subjective guess, but I'm gonna guess probably about 100 basis points lower in yield.
Wow, so that's a full 1 percentage point.
Yeah, because as you go further down the credit spectrum, your probability of default rises quite sharply. So your pricing can be as much as that different from say 260 to 250 basis points of yield pickup in the triple B space, and that's a broad space, to 350 basis points in the double B space.
We're going to test your mental arithmetic now. How much over the period of this bond extra then does the country pay?
I'm not going to do the maths for you.
All right,
I can't do it in my head and convert it back.
So in essence, you take the period of the bond and you increase by 1% the interest that you would pay over that period.
Exactly.
And
when you borrow substantial sums, which is what you're talking about, there's not a small amount of money. You borrow substantial sums, and you multiply that by a government that's actually running fiscal deficits, which are projected to be in the 2.5% to 3% of GDP, and GDP is 4 trillion rand. That means they're going to be borrowing 3% of 4 trillion for the next few years, and that's just new debt, net new debt. It's expensive. The problem with being downgraded is it raises your cost of capital, so that the country, a greater portion of the government spend is taken up by interest expenditure, which takes away from other programs you want to run, whether it's social programs or healthcare or education or whatever the heck else you want to do with the country. Your cost of interest goes up if you get downgraded, which is why it's such a bad, catastrophic thing for the country.
Tax receipts that we saw out in the last week were heralded as a step in the right direction. Clearly, that didn't have enough of an impact on the pricing of this Eurobond.
I don't think people take sort of 1 or 2 or 3 month data seriously. You look at the budget for the year, and whether we're on track to reach that budget. and you look at the medium-term expenditure framework that comes out in sort of October, November, and that's how you kind of assess these things. Looking at short-term data on money flows to government is really it tricks you. It tricks you all the time because it is not a smooth flow of money to or from government.
So it'd be like quarterly results if you were thinking of buying a share.
Well, quarterly results, corporate management tend to smooth, whereas government receipts, they are what they receive. If somebody pays the taxes, it gets recorded. They don't smooth them. So it's very lumpy data.
But the big story, I guess, is to do with economic growth, and that's not a happy picture at the moment.
Right. So governments are able globally and forever to borrow money on the basis that they are that in the macro sense, if you borrow money in an economy and the economy is growing at rates above your cost of money, well, that seems like a good idea. If you can borrow money at say 8% and the nominal GDP growth is 10%, let's say, for interest, then it makes sense to borrow money so you can grow the economy. I mean, that's how we kind of look at it. When you get into an environment where you're paying up now 10% for long-dated debt in South Africa in rands, and you've got GDP growth running at kind of 0.8%, add on inflation, call it 8%, your cost of money is greater than your growth of the economy, and that puts you into what's eventually called a debt trap. You keep having to borrow to pay back debt, even though you're investing in an economy that isn't growing. And so when credit ratings agencies will look at several things, but a key indicator for them is the growth of the country. A country that has high debt, if it's got high growth, can grow their way out of debt. If they have low growth, it goes the opposite way. You get yourself deeper into debt. And South Africa is currently in that trap. We are in a low growth environment with high interest costs. And that is why the ratings agents, amongst all the other reasons that we are all well versed in, that's one of the reasons the ratings agents very much have us on their watch for downgrade.
So the impact on the man in the street is quite clear from what you've said. Economy will continue to go in the wrong direction if you get into this debt trap, and that means you've got to pay higher taxes eventually.
So I don't want to be too argumentative, but if the man on the street thinks he has an outlook that's clear, then he needs to be disabused of that notion. We are living in an environment right now of political uncertainty and therefore economic uncertainty. As a bond investor, I struggle to take a 20 to 30 year view of the nation, of the government debt in South Africa, and I can't have a clear picture of that. Whatever I say today can be proven wrong tomorrow by politics or indeed by economics. So while the growth outlook looks bad at the moment, we're going to have 0.5 or 0.6 or 0.8% growth this year as expected. The reality is the rand has just gone down a lot. The reality is that commodities may be bottoming. The reality is that maybe China, Europe, Japan, and the U.S. aren't in as bad a shape as people think, and you're going to get some global growth. So actually, our growth outlook could improve next month. The outlook is really not clear at all. There's what the expectations are, and then there's the moving parts. If you can get internecine battles within this government with the fiscal authorities, the national treasury versus the political authorities in the office of the presidency doing battle, that is very bad for the country. And eventually, the bond market is how should I say? The bond market is a proxy for voting. There's an old phrase called bond market vigilantes who keep governments in line by increasing or decreasing the cost of debt. So the bond market could actually, while it's had a nice rally after Pravin Gordhan was reappointed, could actually have a sell-off as a political statement against political missteps. It is a very uncertain environment. That's what I'm trying to communicate.
And one of the uncertainties is coming ahead in the next couple of weeks when Lungise Fuzile, the Director General of Treasury, one of the guys who was supposedly earmarked for ejection by during the Nenegate scandal, his contract comes up for renewal. If they don't renew, would that be seen in a particular sense by the bond market?
I don't know that they're focusing on the particular man. I think the focus of attention are on two key figures right now, that being Pravin Gordhan and Jacob Zuma. The rest of the cast of characters is more like bit players, but important bit players. So I think we have to see it in the flow of what might happen. You could wake up tomorrow or next week and find out that boards of large state-owned enterprises have been replaced by a different crowd of people, which would be very market positive, while at the same time somebody you like doesn't get reappointed, for example. There's too many moving parts, Alec, to actually even to say what's going to happen in 2 weeks' time.
So what do you do as an investor, given that we're in a developing country where politics does trump economics, as you've just explained?
Yeah, and that's also a tricky one because I'm not sure politics trumps economics. It ought to. Right now, with the 10-year bond yield at 9.25 roughly, I say, well, I don't really buy that. Inflation environment going up to the high 7% range this year, possibly in the 7s next year still because of rand weakness. 10-year bond just over 9% doesn't strike as very attractive, particularly given the political uncertainty, and yet that is where the market is. So I'm not sure what trumps what. So what is the answer to your question? What do I advise investors to do? I would not recommend any investors, either institutional or retail, to be buying long-dated nominal bonds. And that's a pretty bold statement because right now you could buy an R2050 bond yielding just over 10%. That's a nominal bond yielding 10% against a long-term inflation outlook. If we have political stability and fiscal stability, a long-term inflation outlook of let's say 6%, a 10% yield isn't that bad. But it's the uncertainty I can't live with. But I wouldn't recommend buying those because you can't get your arms around it. Things that are more attractive is inflation-linked bonds, which are, as the phrase implies, it linked to inflation. They will earn a base yield, a real yield, plus the inflation rate. So right now, the real yield on the long-dated inflation-linked bonds is about 1.9%, and inflation, let's say, is going to be 7% for the next 2 years. You'll earn a yield of about 9% for the next 2 years. Not an unattractive thing. It's a relative safety space. If things go really wrong and you're going to continue to get an inflationary environment from the fiscus, or if the Reserve Bank loses its credibility and inflation starts going up more, you've got an inflation hedge, which is a good core holding. Many years ago, they'd always said that gold should be a core holding in a portfolio as an inflation hedge. Nowadays, inflation bonds are a good core holding of, say, to the tune of 5 to 10% of your portfolio as an inflation hedge, similar to your house, for example. Another safety place is cash, of course, money market funds, or even yield-enhanced money market funds, where you can beat JIBAR by an additional 100 to 150 basis points of yield with a bit of credit risk. And the credits in South Africa are pretty stable, so that's not a big stretch. But it's low interest rate risk. It's shorter dated, but it beats inflation by maybe 1% or 1.5%. So that's a safety place. I struggle to see equities as a safety place because of their inherent volatility, because they are subject to global uncertainty and domestic uncertainty, and they aren't cheap. So I struggle to see equities as a safety place. I think of relatively short-dated inflation bonds, relatively short-dated cash and money market instruments, or income funds, short-dated income funds, is your safety place.
Andrew, that 1.9% premium over the inflation rate, is that aligned with a downgrade that everyone is anticipated? In other words, if the downgrade didn't happen, would that premium over inflation contract?
The domestic inflation-linked market doesn't really trade on South Africa's sovereign credit rating, principally because we domestic investors, when we buy rand-denominated instruments from the government, we consider them credit risk-free. That is to say, if the South African government borrows in euros, as they have, a euro investor has to worry about whether the South African government is going to pay them back in euros. If they borrow from me in rands or borrow from you in rands, the fact is they will pay us back because they can print the money. They're not going to default on the debt. They might create an inflation. They might inflate their way out of the debt. They might print too much money to pay back the debt, and that's why ILBs are quite good. They don't have credit risk per se, and they give you a hedge against the last recourse of tyrants, which is to inflate their way out of problems. So it makes them a really suitable holding for portfolios for that reason.
So that is not going to be affected, that premium over the inflation rate, by whatever happens on the sovereign's downgrade. But the impact is certainly going to be seen in the euro currency, or in fact dollar bonds that we might be borrowing in.
Right. And so two thoughts there. First, I can't go as far as say it would have no impact because South Africa's cost of capital is set by the global market, and it does affect domestic prices. I'm just saying it's a second-order effect on the domestic inflation bonds. The other thing about the downgrade when it comes, it also depends how it happens. If we are downgraded in anger and with impunity by the ratings agencies, that is to say, if they imply that we're not just going to downgrade you a little bit, but you're being downgraded and we are still watching you because we're going to downgrade you again in the future, our cost of capital will continue to rise in the global market. If the government makes having made all sorts of promises now to try and retain our credit rating, principally by Prof. and Gordon, if the government does something radically wrong to undermine the credibility of fiscal policy on a 1 to 5 year forward-looking view, the ratings agents will not just downgrade us, but they will make continued hawkish, aggressive statements implying that they'll downgrade us again to double B plus, double B minus, and then our bonds will continue to trade worse globally. So what I'm trying to say is the how matters. It isn't just we got downgraded, and that's in the price. We could be downgraded with the expectation of another downgrade behind that, in which case it is not in the price.
And that just pushes up.
It's all part of this great 2016 uncertainty I'm talking about.
Yeah, and that would just push up the interest rate that the country would have to pay. And being a developing country,
across the economy,
yeah, we have to borrow. Andrew, let's look at two scenarios. Many investors are seeing it as a binary future for South Africa. Mm-hmm. The one future would be Pravin Gordhan remains intact, Jacob Zuma leaves. The other one, Jacob Zuma remains intact, Pravin Gordhan leaves. How would the market interpret, or how would bonds interpret those two scenarios?
So, again, the how matters, right? I mean, in orderly transition in the presidency would probably be very well received. The ascendancy of people who back the Constitution more forcefully and stand for governance and fiscal rectitude would be very good for the bond market. But again, will it be quite that simple? Probably not. On the other hand, if Pravin Gordhan left in the next say 6 months, it would probably be catastrophic. We would be back to where we were in December. And I don't think there's many ways the government, as it stands, could paper over that rift or that lack of confidence. Right now, we are hanging our hat on a budget that was presented a few weeks ago, which shows reasonable fiscal rectitude on a 3-year forward view. However, it's not like they delivered a lot this year. We are betting that they will be able to deliver lower expenditure and reasonable revenue in the next 3 years. You start rolling over ministers of finance and creating uncertainty in that, and the bond market is not going to like it at all. The bond market will sell off.
But how badly? What is that impact likely to be? Or what could it be?
I mean, let's put it this way. In December, when Nini was fired and the new minister was appointed, the unknown minister was appointed with questionable competency, the bond market sold off in 3 days by 200 basis points, from roughly speaking the 8.5% level to the 10.5% level. I haven't seen a bear market like that since the late 1990s. I mean, that's a 4 standard deviation event in the bond market, and it's a clear statement of lack of confidence that the fiscal rectitude has just been thrown out the window. So that's why that Monday morning or that Sunday night when Pravin Gordhan was reappointed, the bond market rallied back quite a bit on Monday and thereafter. So you could see such an event again, is what I'm saying.
Had he not been reappointed, we would
have been a very bad Monday. I can tell you this market was not going to stop.
Not going to stop at 10.5.
Nobody that was going to get in the way of that train. Rates were going up, and if there had not been a radical reversal, the rates would have continued to go up. I mean, how could you hand over the keys to the Treasury to an unknown political appointee who didn't come through the system and you have no confidence in their ability to run a fiscus, and then expect institutional or retail investors to be holding 30-year government bonds? It would have been a crazy proposition, and the mood of the market was very dark. It was very dark.
Where is it now?
Funny enough, it's surprisingly sanguine. It's quite, it's like, well, okay, things are under control and Pravin is secure. And while they're chirping at him from the sidelines about the rogue unit that may or may not have been rogue, that there's a belief in the great cooperation between business and the Department of Treasury. There's a belief, I think, that the ANC, broadly speaking, is getting its mind right about running the country. And I don't think there's any real belief that the ANC is going to stop running the country, by the way, although there's talk of a split. But I'm not a political analyst. So the market seems pretty comfortable at the moment. As I say, the yield on a 10-year bond at 9.25% going into a 7.5% or higher inflation environment actually is a pretty good vote of confidence in the country right now.
But with the growing calls for the president to step down, concerns that he has allies who won't take easily to that if it does happen, is that in the price as well?
I don't think so. I think we're going to be, as I said, we're going to be sitting in a very emotional market this year because it isn't just domestic factors. It's what the Fed's going to do. It's what the global growth environment looks like. It's in the global interest rate environment. What it looks like. There's a lot of moving parts this year. And so it's hard to put your arms around that, but I'm betting on uncertainty, and that's why I'm saying would keep your interest rate risk relatively lower than you would normally.
Andrew Cantor is the Chief Investment Officer at Futuregrowth, and this special podcast was brought